Thanks for being here. So, why do you believe that it's really the macro data that the market will focus on? And why do you think that the markets have had somewhat of a muted impact this morning to the conflict abroad?
It's a great question. I mean, I guess the way I'd look at it is the stock market reaction is telling us that they are viewing the conflict as ultimately limited in time and scope. If there was a bigger sell-off, I'd actually think the market was really smelling something much more dangerous and engulfing. I know people are focused on oil and the fact that the bond markets are closed, but we can see what interest rates are likely to do tomorrow by looking at ETFs like TLT, and it looks like interest rates are falling. I mean, I think that's a more singular impact on stocks anyways.
What do you think the ultimate impact of that would be? You said interest rates should decline sharply when the bond market reopens on kind of this risk-off sentiment, breaking the higher for longer fever that's existed for a while now. If that does happen, how much support do you think it actually does provide for stocks?
I think it's going to be quite substantial because, if we look at investors, they're looking at an economy that's been stressed and then now under increasing stress because long-term interest rates have really pushed up. I think we're seeing Fed governors starting to pushback's not the word, but start to realize that if it's term premia that's rising, that's acting as a huge drag on the economy. Well, now we have a conflict that could undermine consumer confidence. And so as a result, I think it's now changing the calculus. And I think the FOMC and the Fed are more likely to pause. I mean, to me, that's probably my big takeaway. And I think that takes away a downside case for equities. And it also makes it harder for interest rates to keep pushing higher, which, of course, is something that could break the economy.
That was Logan's point this morning, Tom, all about term premium. And she's been known as being relatively hawkish. Couple that with the volume on TLT last week. Are you willing to make a call that rates have peaked?
Carl, I'd love to be able to say that. I think bond markets are really tough to call. But, yeah, I mean, it looks like if you aren't seeing rates push up higher today, which means TLT's down, well, we might be running out of reasons for interest rates to keep going up. And as Walter Deemer says, when a parabolic move like this reverses, it's not taking the escalator. It's going to come down sharply.
But, Tom, what about the oil impact here? In previous crises in the Middle East, we've seen oil skyrocket. Obviously, the dynamic is different today than historically. We can't make a direct analysis there. But, are you concerned at all about the potential for oil to go above $100 a barrel and the implications therein for, inflation to resurge?
Oil should have been up a lot more today if the market was worried about disruption from production. I think oil really weakened. We've had supply cuts all year, and oil's been weakening because we know demand's quite weak. I don't think demand is necessarily picking up. And, at the end of the day, I do think if it was going to make its move, it should have made a bigger move today. But again, interest rates in oil are very hard to predict, but to me, it's quite a muted move in oil.
Interesting. Well, up about 4% for ICE Brent currently. We'll keep an eye on that throughout the day and the days ahead. Tom, thank you.
Thank you.